Hello, everyone. Today I want to talk about what numbers you need to look at if you want to have a monthly mortgage payment of around $3,000. Now, why $3,000? Well, a lot of the buyers I deal with, I've noticed their typical rent is anywhere between 1,500 to like 2,500. So when I tell them what a monthly mortgage is or what it's going to cost them to own a house, a lot of them are surprised or pushed back or kind of intimidated, right? And I get it, right? It's a $500,000 home. It's going to cost you, right? Um, but one thing I recommend all buyers or all potential buyers is to have that mind shift because you're going to be buying a house. You're going to be building equity. That money that you're spending is going towards equity, right? You're building equity. It's like a piggy bank almost in a sense. So as opposed to renting, right? It's 100% interest, money you're not going to get back. So even though it may be more affordable from your experience or from, paying 1,500 to 4,000, huge shift. But again, that's money that's going towards building equity. So it's a shift. Also, a lot of times, a lot of renters are going from maybe a 1 bedroom to like a 2 bedroom apartment into like a 3 bedroom home or even a 2 bedroom home, right? It's a significant jump. Typically, homes are bigger. There are more fees associated with them. So it's just a lot more going on. So don't let that initial payment kind of scare you, right? Or if, just be realistic. Know that you're buying a property. You're having ownership in the property and you're building equity. That's very important because, again, a lot of first-time home buyers see that monthly mortgage payment or see what it's going to be or potentially could be, and they get taken back. So one thing I always ask my buyers before they buy is what's a monthly payment you're comfortable paying, right? What works for you and your family? That's crucial. Because even though you may qualify for something higher, you may qualify for a higher payment, it may not always make sense for you and your family. So I always tell all my clients, listen, just because you qualify it doesn't mean it's affordable. It doesn't mean it makes sense, right? So even though you may qualify for X, maybe you're comfortable paying for Y. So let's bring it down to that level. I'm from California. I originate in California. I live in SoCal, Ventura County specifically. So the homes in my area are typically pricier. However, California is huge. So just because the numbers I'm going to show on screen right now may not necessarily work in your town, just know California is vast. There's a lot of different counties, a lot of different cities that are more affordable, right? I happen to live near, near a beach, so obviously that drives prices up. But again, there's just homes everywhere. So don't get discouraged. Even if you see purchase prices that may not align with where you're at now, have an open mind. Consider maybe trying out a different city, or looking into a different city. Because again, you're going to be building equity. That's huge. Build equity, own the house for 5-6 years, and then later pull the money out or sell the home, right? Home values typically have been going up. Pull the money out and then buy a bigger house, right? Just take it in steps and strides. But with that said, I'm going to show what purchase prices you should be looking at if you want to keep your monthly mortgage around the $3,000 range or as close to $3,000 as possible. Now, I'm including property tax, I'm including hazard insurance, and I'm including mortgage insurance in these numbers. So I'm not just going to give you principal and interest, $3,000, everything combined, right? So I already did the math, but I have it here on the screen next to me. I want you to see these figures, right? So let's say you come to me, or let's say you hey, Edgar, I want to buy a house. I want a 30-year fix, conventional, and I want to come in with the minimum, right? 5% down payment. You can go 3%, but let's just go 5% for the sake of this example. So in this example, these are the assumptions I'm making. Property tax, I'm assuming it's 1.25 of the purchase price. That's mainly what I see in California. Some counties, some cities are a bit different, but for the most part, 1.25% of the purchase price is the property tax that I usually see. Homeowners insurance, I'm keeping it to $80 a month. Again, that changes as the price of the home goes up or depending on the area, many factors, but on average, that's what I see a lot, at least with the clients I deal with. And then we're going to leave out HOA for now, but we're going to come back to that and do that in a bit, right? And then lastly, mortgage insurance. Where's my mortgage insurance? Should be in here somewhere. Oh, it's not showing because I have over 20% down. Let's do 5%. Mortgage insurance, there we go. 0.36%. I just got that from one of my banks that I use. That's kind of their standard. So we're going to go with that for now for this example. And in these examples, I'm doing a 7.5% interest rate as a framework, right? I'm not quoting you this rate. Each rate is very fine-tuned to your situation, right? Rate is highly determined by your FICO score, how much you're putting down, where you're buying the house, the loan amount, several factors, right? But just for the sake of argument, I'm going to use this rate, 7.5%, conventional. Again, there are costs associated with rates, right? So you can buy the rate, you can bring it lower, you can bring it higher, but just to give you a point of reference, and for the sake of these examples, I'm going to do 7.5. Again, I'm not quoting you on this, but it serves as a good kind of benchmark to start. And I'm shooting this video on April 4th, 2023, right? So if you know that down the road rates are higher, just kind of adjust and figure out where you stand, and just right, if you have a higher rate than what's on here, know that your purchasing power is going to go down. If you have a lower rate, it's going to go up a bit higher. But again, this is just to kind of help serve as an example. So with that said, let's get started. So for the first example, we're not going to do, for the first three examples, we're not going to do any HOA. So let's say, hey Edgar, I want to buy a house. I want to put 5% down, and I want to pay as close to $3,000 a month as possible, right? So if we go over here, this is the purchase price. So for 5% down, right now we're at $33.48. We're looking at a max purchase price of maybe, let's see, $370. And again, I did these numbers beforehand, so, but I want you to see the layout here on my right hand, or that side of the video. There we go. Sorry. So here we're at $3,028, right? Interest rate at 7.5, 30-year fixed conventional, 5% down. The 5% being $18,500. So if you see the breakdown here, we have the private mortgage insurance, which is $105, property taxes $385, and homeowners insurance at $80. Right, total $3,028. So if you come up to me, or if you came to me and these were your figures, this is the purchase price, I will tell you, hey, we should stick around this, right? Now let's say, hey, you're a buyer that saved, quite a bit. You want to put a larger down payment. Specifically, you want to put down $50,000. Like, hey, Edgar, I have $50,000 for down payment. What purchase prices am I looking at? Sure. So if you go, excuse me. So let's do $50,000 down payment. And again, I did the numbers beforehand, so I already know I'm going to input, but I just wanted you guys to see the figures as I do them. So in this case, $50,000 is roughly 13% down payment of $400,000 purchase price, right? Again, we're very close to that $3,000 a month mortgage payment. Principal and interest, mortgage insurance, property tax, homeowners insurance. Now, one of the payments we can take off here will be mortgage insurance, right? If we put down 20% or more on conventional, we can remove the mortgage insurance, right? So let's say, hey Edgar, I have $100,000 to put down as down payment, right? I want to maximize my purchasing price, but I want to keep my monthly mortgage at $3,000 or as close to $3,000. Okay, so let's see what that looks like. By the way, if you guys want to play with this website, I'm using RamseySolutions.com. There's a lot of mortgage calculators. I just like this one because it's more visually appealing. So at $100,000 down payment, you're looking at purchase price of around $460,000, right? To get close to the $3,000 a month range. Now this is 22% down payment, right? So that's $100,000 of this amount. That's 22%. So again, we're above the 20% down payment threshold, so we don't have to pay mortgage insurance anymore on a conventional loan. So you can see that we remove that payment overall. So now we're looking at a $406,000 purchase price. And here's your principal and interest, property taxes, and homeowners insurance. And again, these are just estimates. The homeowners insurance is an estimate. Property tax is a percentage, and then this is just determined by the loan amount and the rate. But again, these figures, right? If you come in with the 5% minimum down payment on conventional, you're looking at $370. If you have $50K, you're looking at $400, and if you have $100K, you're looking at $460, right? And again, I can't stress this enough. Your numbers will differ, right? Your interest rates will be different. But again, this is just use this as a framework, something to kind of bounce off from. Okay, now let's say, hey, or you come to me, hey, Edgar, you know what? I really want this condominium. It's super nice, or it fits with my needs. Well, condos typically have HOA fees, right? In my example, the ones I worked with, typically HOA is anywhere between $300 to $400. So I'm going to do $350 just to be in the middle. So now we have to take into account the HOA fee, right? It's consistent. It's a constant payment. So now we have this additional fee. So if you want to get a condominium and still pay around the $3,000 mark, we're looking at a purchase price of $330,000 with the 5% down payment, which comes up to be $16,500. Again, the same scenario. And this is the breakdown: principal and interest, private mortgage insurance, property tax, homeowners insurance, and HOA dues. Now, the first example where we didn't have HOA fees, you're looking at a purchase price of $370. Now we're at $330. So $40,000 difference. Again, that HOA fee does make a big impact. Okay, same scenario, but now you want to come in with $50,000, right? So let's do it. Remember last time where we did have an HOA fee, we were able to get $400,000. Now we're looking at $360,000. Again, a $40,000 difference to stay within this $3,000 monthly mortgage range. Again, you can see my figures, how the math updates on this side. And again, HOA, it's a big fee. It's a big hefty fee. I've seen some condominiums HOA fees under $100, and I've seen some above $700. So just things to keep in mind. But just as a general example, this is what I'm using. Now let's say you want to come in with $100,000 again. And remember, the last scenario we were able to get up to $460. In this case, we're able to get up to $410,000. And again, we're at near the $3,000 a month range because we're paying over 20% down payment. We don't have to pay the mortgage insurance on conventional, and I stress that because on FHA you do have to pay the mortgage insurance. So conventional you don't after 20% down payment. So, or LTV. So as you're paying off the loan, once you own or you build 20% of the equity, and LTV is down to 80%, that payment goes away. So in this case, $410,000 is the purchase price for this example. Compared to the one prior where we didn't have HOA, we were able to get $460. Now we're at $410, so $50,000 difference. And yeah, so this is just some baseline, some examples, more like frameworks. Use this to kind of know where your numbers may lie, right? If you've been pre-approved, just have an idea of where you stand. Just know that HOA is going to impact your monthly mortgage payments. And just because you qualify doesn't mean it's affordable. So speak to your lender. If you can, buy a $600,000 home, but the monthly payments is just too much, be upfront about it, because it's important for you to have a payment that you're comfortable with, because you don't want to be working nonstop just to pay the mortgage, right? You need to have a life too. At least I'm in that opinion. So yeah. And one thing to keep in mind too, another just kind of broad example is I'm using down payment here, right? So I was showing some examples, 5% or 50K or 100K. Aside from down payment, there are closing costs, right? Closing costs play a big factor of how much you need to bring into the loan at closing. You're looking at escrow fees, title fees, prepaids, several factors, origination fees, right? So always look at your APR. Your APR is going to tell you what, if you're getting a good deal or not. So you can be getting an amazing rate, but you can be paying for that. You can be paying significantly. So just keep that in mind. So if you have two different quotes and one's rate's better, just look at the APR. You have a good way to compare. And if one has a really high APR, they're charging you, right, for the rate. It's not a bad thing. It's just be aware of these things. And in my field, when I'm doing just examples or pre-qualifications, I typically take 2.75% of the purchase price, and I make that an estimate, just a really good estimate as to what you need to bring for closing. Now, in today's market, buyers can get seller concessions, right? So sellers can help you with closing costs. There are percentage limits, but talk to your agent and talk to your loan officer and see if you can negotiate that with the seller. Because again, we're in that market where that is common now, or at least I see it often. So, just food for thought. So yeah, again, I know I'm just rambling, but if you're renting, and again, I'm in California, I originate in California, and homes are pretty pricey here. But if you're renting, just know that it's a big shift from maybe $1,500 a month to $3,000, $4,000, etc. But you're building equity. Think of it as putting money into a savings account, a piggy bank, right? You can pull that money out in the future if you need to. You can refinance at one point if the rates go down. So there's a lot of things you can do. I'm a strong advocate to get people into owning homes because rent is 100% interest. So as long as you're paying rent, you're not going to get that money back. And regardless, you need to live somewhere. So you're going to be spending either on rent or owning a home, right? But end of the day, it needs to make sense for you and your family. Don't get tied paying a monthly mortgage that doesn't make sense, right? That's going to really bring stress, right? You want to have your life. You want to work and have a balance and be able to pay the mortgage and kind of grow it from there. So yeah, I hope these examples help. I'm going to be posting a lot more videos for first-time home buyers and investors. So if you have any questions, feel free to leave a comment or DM me directly or send me an email. So yeah. And if you'd like to get pre-approved or would you like a second opinion on your pre-approval, feel free to message me. Again, I originate in California. My name is Edgar Limon. And yeah, so see ya.